Hi, everyone. Welcome back to another episode of Reinventing Finance together with my lovely co host, Tom. Tom, how are you this fine morning?
Thank you, Nick. I'm fine. Looking forward to our
Awesome.
conversation.
As usual, it's not just the two of us by ourselves ideating and philosophizing about insurance. We have Natalia Dorfman with us from Kita Earth. Natalia, thank you so much for taking the time today. How are you?
Yeah, I'm well, thank you. I'm very happy to be here.
Awesome. Natalia, could you briefly introduce yourself and your company, and any kind of context and background you think is helpful for people to kind of segue into insurance, ESG, carbon, climate, all the nice, sexy, vogue buzzwords.
Yeah, of course. So I'm Natalia Dorfman, CEO and co-founder of Kita. Kita is a carbon insurance company, which in essence means that you have these two, I like to think of sort of a Venn diagram. You have the carbon markets, which you've probably heard the voluntary carbon market, where companies with net zero strategies will go to buy carbon credits, such as that they can help to compensate for the carbon emissions that they're putting into the world via paying for things like planting trees or other forms of carbon removal. So you have the carbon markets, and then obviously you have insurance. And I like to think of them as these two circles. Both of them are quite complicated. People who understand carbon don't understand insurance. People who understand insurance don't always understand carbon. Kita sits at the intersection of those two things. And so we like to think of ourselves as a bridge that can explain one side to the other and also build partnerships between them. And really the reason that we started Kita is that we see insurance as a necessary enabler to drive more financing to help high quality carbon projects scale. And carbon projects need to scale because right now we have too much carbon dioxide in the atmosphere. And even if we stopped any kind of emitting activity today, we have too much carbon dioxide in the atmosphere. We need to take it out to fight climate change, and carbon removal solutions do that. Kita is a cover holder under Lloyds, and we've just launched our first product in February this year. So yeah, really excited to be here and happy to go into more details on any of those things.
Just so that I didn't overhear, but it's a voluntary carbon markets, right? So it's not like EU starts putting a price, not those carbon markets. You're talking.
Actually, it's either. When I
Okay.
say carbon markets, there are two carbon markets at a high level. One are the compliance markets, which would be things like the EU emission trading system. The other is the voluntary carbon markets. There's actually insurance need in both of those markets. Compliance markets are a lot larger. It's around 800 billion today. Voluntary carbon market is tiny in comparison, around 2 billion today. Both both markets need insurance. I think the voluntary carbon market is where a lot of intention is being paid because that's a market that needs to scale from around 2 billion today to upwards of 50 billion by 2030, just on the basis of actually how many corporates need to engage in that market to meet their net zero commitments. And the voluntary carbon market lacks regulation and lacks transparency, is a challenging market to engage into. So thus there's a lot of insurance focus there, but actually we're reasonably agnostic as to the market. Right now, our insurance was more focused on a type of transaction within either carbon market, which is a forward transaction. Putting down money into a carbon project today, for example, to help someone plant young trees, and then I will receive what's termed a verified carbon credit in the future. So for example, those trees take 10 years to grow before someone can assess how much carbon they've captured. So that person or companies put down money today, has to wait maybe 10 years before knowing if my investment has generated a return. And we protect the upfront investment against the risk they might not receive a verified carbon credit.
And against perils? Which perils are insurable today? And where do you see potentially more development needed?
Yeah, of course. And I should probably take a step back in terms of explaining some of our thought process when we were early and I guess ideating about Kita. Because I guess in terms of the reasons why we started an insurance company in the first place, and when I say we, this is myself and my two co-founders, we met in an organization called Carbon 13, which is a venture builder for climate tech startups. And it's led out of Cambridge in the UK. And the purpose of Carbon 13 is to build companies that can remove millions of tons of carbon dioxide from the atmosphere every year. And so we went into that organization thinking we would build one of those companies. The reason we ended up doing an insurance company is because we saw the lack of insurance for this new and emerging space as a real ceiling to growth. I think anyone in the insurance industry already knows this, but without insurance at some level, you hit a ceiling of financing. There's too much risk sitting on market participants, sitting on balance sheets, and you just hit a ceiling. I think people who start climate tech startups don't necessarily think about insurance from the get-go. And so we were speaking to people who were talking about how quickly they were going to scale these new technologies. And the key thing that kept coming to my mind was, well, how are you going to finance that scaling in the timeframes that we're talking about this decade? And you're not going to do that without insurance. And so thus that was our initial thought of insurance is actually a gaping hole here in the sort of carbon space. And we need insurance to provide that risk transfer to enable significant levels of financing. So thus we started thinking about what type of insurance is needed. So going back to your question, what is insurable and what would people want to insure? We started out looking at nature-based solutions, which is, I guess, a lingo I shouldn't necessarily use, but in essence, it means nature. So planting trees, restoring peatland, mangrove forests. Nature inherently captures carbon. Just in itself, a tree is made out of carbon. And so as trees grow up, they capture carbon. And so thus planting trees is a very effective way to capture carbon. And it's also one of the largest ways that people engage in the carbon markets today is via these nature-based solutions. And so we started out looking at that and talking to people around what are the key risks that concern you most, right? If you're paying for a carbon project, are you most worried about fire, wind, pest, disease, negligence, fraud? Like, what is it? And it became immediately evident that actually people don't really care why they got their carbon, right? It's not fire that is like the number one concern. Just the key thing they're concerned about is that they didn't get their carbon. They don't really care why. And so thus we quite quickly started looking at more of the all risks type insurance policies. So parametric, warranty, credit, surety. And that's where we are now. Our product looks most like a credit insurance. It isn't full credit, but it sort of looks most like credit. And we came to that in large part via Lloyds Lab. So I'm sitting within Lloyds right now. It has this distinctive kind of sofa background. But we were in Lloyd's Lab last April, and
Lloyds or WeWork?
Yeah, it's one of the others. It happens to be Lloyd's.
Yeah.
But yeah, within Lloyd's Lab, we work with our mentors, so including Chaucer and Munich Re-Innovation Syndicate, who now provide capacity for us, and they help steer our thinking from that kind of, is it a surety bond, is it credit, into what it is today, which is what the market needs, but also bridges that gap, which I think you need with innovative new insurance products. It's what the clients need, but it's also what an insurance company is able to back because they understand it. It fits into the sort of realm of what is insurable. And so it looks like a credit policy. It's an under delivery of carbon for an almost all risks type policy, but an under delivery that can't be made good via the terms of the contract, the carbon contract between the seller of carbon and the buyer of carbon.
And how does that, so when you say, how does making it kind of like a credit insurance allow an insurer to move towards more of an all risk policy? What are the maybe insurance specific aspects of it? Because credit insurance, surety, these are very specialty lines. This doesn't, it's not necessarily something you can spend your whole life on very interesting insurance related projects without ever really touching the specific market. But it would be interesting to understand, one, how that structure allowed you to capture more of the all risk element, because all risk is always difficult to price. and potentially which specific elements, and again, obviously, you know, you don't spill your secret sauce here or anything, but some, I guess ultimately a buyer of that protection would want to understand what's protected anyway, to understand what specific challenges the carbon markets or carbon removal markets have that you kind of needed to add on top of a kind of normal credit insurance program. Because I
Yeah.
don't quite yet understand it. I mean, I was like, yeah, I've heard about these things, but it's not.
Yeah, of course. Why don't I start then with the specific aspects of carbon markets that are challenging, and then we
Yes.
can go into what the insurance policy itself looks like. So there's a few things, and I'm going to stick within the voluntary carbon market here, because that's broadly speaking where the types of transactions we're talking about lie. But there's a few things that make this market interesting and specialist. So one, I guess, is that you are in essence insuring an intangible asset, but that is linked to a physical asset. And so you are, the physical asset is, let's say, the trees. I am paying you to plant trees, and as those trees grow up, they're going to capture carbon. We're going to quantify that carbon, and it is going to become a carbon credit. A carbon credit equates to 1 ton of carbon that has been captured. And so when I pay you, I'm in essence paying you to start and maintain a physical asset, but what you're going to give to me is an intangible asset. And so that in and of itself creates a slight nuance in that it's almost, which are you insuring, which are you protecting? And to some extent, it's both, right? So you could insure you, let's say you're the project developer, you might need insurance just for your trees. That could be very normal insurance, fire insurance, so that if your trees burn down, you can replant them. Likewise, you might have signed a contract to deliver carbon credits. And if you're unable to, your trees burn down, you get money to replant them. But likewise, you still are going to be, let's say, 3 years behind on your delivery schedule. And thus you're not going to have the tons of carbon, this intangible asset, which has its own value in and of itself. So to some extent, you're trying to understand this market where you're paying somebody to start and maintain something physical, but what you're receiving in return is intangible. And that intangible asset has its own value and can be considered its own asset class. So that's one nuance there, that the carbon credit itself is an intangible asset. The second point, I suppose, is the market price risk. So that carbon credit is a very variable asset in terms of its price. So the voluntary carbon market doesn't have any set pricing tools that are trusted. And most of the transactions are done in a reasonably opaque fashion. And so there is no set market price for, if I pay you £5 a ton versus £30 a ton, it starts to become an individual negotiation. And thus it's hard to value the sum insured to some extent. What is the value of the asset? And then over the life of these carbon projects, that asset can change in price dramatically. And so it's important, obviously, for the insurance company to manage its market price risk in terms of quantifying the value at the time of loss. And then I suppose one of the final, not the final, but there's many things that are nuanced in this market. But I suppose one final point that I will make is it is very important for insurance to fit into the structures of the carbon market. And so the structures of the carbon market are, broadly speaking, around the carbon standards and methodologies that people use to develop these projects. So if you are going to develop a forestry project and sell it for carbon credits, you don't just go out and do that on your own. You have to do that in compliance with one of the carbon standards out there, let's say a Vera or a gold standard. And you have to follow one of their sub-methodologies on how you are going to plant these trees. So it'll tell you, how do you plan your project? How do you get it validated for how much carbon it should generate over its life cycle? how do you get that validation approved by the standard? And then over the life of the project, how do you get regular audits, in essence, verification points that quantify the tons of carbon that were projected? Have they actually been sequestered now into these trees? At that point, that carbon credit can transfer to its end owner on a carbon registry, at which point the end buyer can receive a verified carbon credit and use it against their net zero targets. Following the rules of the carbon standards is a bit like, at a high level, it's very easy to understand, but then it's like entering into quicksand. Once you get into the details, it gets very quickly confusing. And so one of the benefits that we bring is the ability to actually understand the nuances of the underlying market, and thus how insurance needs to fit into these transactions in a way that makes it an enabler rather than a kind of blocker. And that has to link up also with, I suppose, the other challenge of the carbon markets, which is the length of these projects. So there's no benefit to society if carbon is only captured for a couple of years. Carbon dioxide, once it's in the atmosphere, stays there for thousands of years. So one of the core tenets of the carbon markets is that carbon, once it's captured, has to stay captured for ideally 100 plus years. And so people buy carbon projects for timeframes of 30, 40 years. And so how do you build insurance that still works with the carbon markets, but that recognizes these long timeframes, which is a key challenge in and of itself.
Would you say that I would assume a lot of the buyers of these credits are in the Western world, also driven by it's voluntary, sure, but also by certain customer and political sentiment, right? Whilst a lot of the, let's just leave it at reforestation, is probably more in the developing world. And as with, if you kind of look at a lot of the political debates, one kind of is this a catch-22 argument? Is that, yeah, there's corruption. I mean, we would give them more money. We would love to get those mangroves up and pimping, but I mean, can we trust them? How do you, and you know, there's probably anecdotal evidence that you could stack up and say, listen, you know, this is really hard to, you know, how do you even get into, I don't know, you know, into the Amazon, wherever that is, right? You know, the how does that verification element, that trust element, how do you, what's your role in bridging that? Because it's almost, if I don't trust you, everything else I don't engage, especially if I don't have to. How has that been a big problem, and how are you tackling that?
I'd say that's a huge problem for the carbon markets, widely speaking, the lack of trust.
Yep.
The lack of transparency. And I think increasingly, I would say corporates with net zero strategies are within sort of a rock and a hard place type situation, right? Because of what you said, you know, they have net zero strategies. They're increasingly facing sort of regulatory and social pressures to act upon those. But when they do act, if they make a mistake or engage in a project that is later deemed to be problematic, they get put on the front page of the newspaper. And so from that perspective, you know, it really is a challenging situation for a company to be in. And the lack of trust and ability to engage in the market is challenging. So I'd say, I actually think this is an area where insurance provides a real stamp of confidence, because buying carbon is a challenging thing to do. Most buyers will either build up very significant in-house teams who do significant amounts of due diligence on the projects, but only a few of them are of the size that can do that. The majority of them will engage with some form of external consultant or advisor who specializes in purchasing carbon, and thus they trust that advisor to do diligence on the underlying projects and decide, you know, which one is a high quality carbon project. Again, you might not trust fully in that, and if you're going to stake your reputation on it, You want to believe in what you're doing. Insurance has the ability to come in as an additional stamp of confidence because we will do our own diligence. So we will have our assessment of which types of projects and which methodologies under those standards do we think are insurable. So which of those do we think have the appropriate levels of quality guidance, ongoing verification, the right auditors who have the appropriate levels of experience to actually engage with these projects successfully. We look at the track record of the project developers. We look at the corruption indices in the underlying countries and our ability to assess things like land ownership rights. We do a lot of analysis across these projects, which provides our client with an additional level of due diligence. And importantly, with insurance, not just the due diligence, but actually the confidence we got it wrong, we'll pay a claim. And so I think insurance, just on the very core that insurance companies don't insure things they think are going to pay a claim. If you can buy an insured project, it provides that confidence that I think somewhat is lacking in the market right now. And so that is our hope, that actually insurance therefore can be a driver of finance to help the high quality project scale. And we will only insure a project if we think it's meeting the quality metrics that the carbon markets, really should be abiding by. So is the project doing what it says on the tin? It is capturing carbon and it's not causing any harm. Those are the projects we're trying to engage with.
And so similar to any new risk, really, you'll start with your own, you probably start with, underwriting, assessment, etc., expanding a database, and learning as you go along. And really, that's why you set up as a cover holder. And that is usually where, I would argue similar to originally, marine cyber, you see that as well, where, in a specific area of expertise, a continuous area of expertise is required to kind of price and underwrite these risks that requires a high level of sophistication and specialization. And that might be better set up in a specialized entity than, someone's Thursday afternoon job.
Yes.
Okay.
Yeah, I think the analogy to the cyber market's a really good one, actually, in that it's a intangible asset and the market that's basically new, and people have been managing the risk in their own ways for years, and now you're introducing insurance as a new way to manage that risk, and it is a new market without that historical claims data, where one of the biggest challenges is education of the market in terms of what is insurable, what isn't insurable, and what the price of insurance and levels of coverage should be. And that will be an ongoing education process that ourselves, as well as other insurance companies coming into the market, will be engaging with over this decade, I think.
And to kind of get an assessment, you've mentioned 2 billion is the current voluntary carbon market. How much of that value is currently insurable?
Well, depends what you're insuring, I suppose. And I think that's one of the things here is that you can make analogies of the carbon markets either to maybe like a commodities type market, in that you have an underlying project that is capturing carbon, not that dissimilar to say an underlying project that is, drilling for oil. You have a company that is doing a thing. Then you have buyers who will buy that thing, and often in different types of ways. So with oil, let's say in the political risk market, you have forward purchases of oil. You have non-delivery of those oil. Same thing. So you have buyers who are buying that carbon, and then you have a market that springs up around that asset. So just like you'll have oil traders, you have carbon traders, but you have a market, a financial market that springs up around it. So you have that analogy of the sort of commodities market. And then you can see within the commodities markets how many types of insurance exist in that market, right? There's a lot of different types of insurance. And as such, almost anything is probably insurable, but not with one magic insurance product. You have a lot of different types. Likewise, another analogy that you could make would be the bond markets, where carbon credits could be seen as something that could be securitized over time. and with ratings agencies springing up to assess the quality, A plus, et cetera, et cetera. You can make that analogy as well and look at what insurance exists within the bond markets. And so as such, I think depending on how you look at it, almost all of that market could be insurable for one thing or another. But there is not one insurance product that can cover all things. So our product for forward purchases, which is, again, the companies that are putting down money up front to receive carbon delivery later, is a subset of that 2 billion, but it's a growing subset. If you looked at a product like a political risk product, where, if buyers who are, like you said, engaging in carbon projects in developing worlds might be worried around host countries keeping the carbon, that is a quite reasonable sized market, but actually a very challenging insurance product to deliver right now. If you look at things like fraud and negligence, that is probably actually anyone in the market might be interested in a type of fraud and negligence product to protect against the underlying risk that maybe there was some form of fraud or negligence in the underlying project that might result in a problem for the buyer. So it's all about how do you actually, like with any insurance product, it is what is the risk, what is the value of that risk, and then what is the sort of trigger that would indicate we've had a loss. And there's a lot of products you could bring out here.
Okay, so basically, I was kind of where I was going for was, how much of that, like a quality assessment, how much of that would be deemed insurable, while still maintaining an underwriting profit, to kind of get an assessment of quality of projects out there. Do you have, is there like are we talking, would you say 10%? Would you say 90%? Where do you not actually want to comment because
I would say we have our assessments of it, but I'd say it is hard to know at a broad brush level how much of the market, I suppose, is high quality enough to insure. And again, the carbon markets break down into types of projects. And those subtypes of projects will have different quality levels. So you will have things like household devices projects, which will be things around giving clean cook stoves to people so that they don't have to use wood burning cook stoves. You will have things like avoided deforestation projects, which is where I would pay you to not cut down your trees because actually conserving our forest is a huge priority. You have things like your afforestation projects, planting new trees. You have your technological solutions like direct air capture. And you have this whole range of other things from methane to grasslands to soil. And so it's not let's just look at the carbon markets and it is very much actually understanding the subtypes of projects, and then understanding what makes a quality cook stove project is different than what makes a quality avoided deforestation project versus peatland restoration. They all have sub risks that can make them go wrong, and that is one of the things you need to understand. So I'm not going to give a high level answer because it's challenging, but avoided deforestation, for example, is one that comes out in the press a lot. And then you've probably seen the recent Guardian articles. Those are broadly speaking around avoided deforestation projects. And there is where the challenge is around something called baseline. And so that is, if I pay you not to cut down your trees, and I'm going to generate a carbon credit to show that my payment to you made you not cut down your trees, what is my baseline assumption? The baseline being, how much would you have cut down those trees if not for my payment to you? And it is a inherently challenging baseline to assess because it's hard to gauge what you would have done in the future if I had not paid you that money today. And so thus a lot of those projects in recent years have had challenges around their underlying baseline, which then challenges how much carbon has come out of the project. But this is a problem that is greatly discussed within the carbon markets, and those baseline assessments they need to be a constantly evolving thing. And so again, within insurance, if you're going to insure a avoided deforestation project, let's say, for delivery risk, you need to calculate in your expected baseline shifts over the life of your insurance, such as that you can price for it rather than be surprised by it. And again, that's where one of the benefits of Kita would come in. When we work with our capacity providers, it is us bringing in the knowledge of the carbon markets, and then working with them based on their strength of knowledge of the insurance markets and the ability to structure different products.
This sounds very much like kind of large, it's basically over-the-counter customized solutions. At which price point do you feel makes a be that portfolio of carbon projects or premium? At which point does all of this make sense, as it's not, this is clearly not a retail product right now.
No, it's not a retail product.
We're a few steps, away from that. So that then indicate, what kind of insurance sums on similar, projects or multiple projects, or premia are we kind of roughly looking at, so to make all of this assessment commercially viable?
Yeah. I mean, again, we have tried to look at analogies of what insurance is in other markets. So with our first product, we look at a lot of the political risk trade credit market to look at what the price kind of expectations are there. So we try not to go too far out of that. But then within the carbon markets, it depends a bit on the type of buyer. So you have, broadly speaking, your corporates with a net zero strategy, and they are buying carbon to meet their net zero strategy. And then you have companies who buy carbon because they see it as an asset class. So you have your investors and your traders, and they're looking more at a return on their investment. And so they have, these two buyers have different price points. So your corporates today will often overbuy, maybe overbuy by 30%, because they're worried about getting it wrong. So thus they're going to overbuy. And so almost one of the comparisons you have is currently they're almost a self-insurance of a 30%. Our insurance policy isn't 30%. And so it's helping them understand actually how can insurance help you to reduce that need to overbuy, because we can actually help to direct you towards a higher quality project and then provide you the safety in terms of an insurance claim to enable you to reinvest back into the market. And so that's more with the corporate buyers, slightly less price sensitive, I would say, at a high level. In terms of the companies who are looking at generating a financial return from these investments, obviously they are then looking at how does insurance impact my return. And so thus with our first product, one of the factors there is that with our product for delivery risk, you can engage with the carbon project earlier in its life cycle, at which point you can get a better price for the carbon. So with carbon projects, the earlier you engage with the project, the more of a forward purchase you do, you get a better price. And so a lot of buyers, because of shortages of supply of carbon and also the expectation that prices are going to go from $15 a ton or so today to upwards of $150 a ton by 2030, a lot of people are trying to lock in price today. And so thus, if you think by forward purchasing today, you can get a better price, but you don't want to take on that risk that you don't receive the carbon, the insurance added on top of the preferred price today can become actually a very cost beneficial exercise for you. And so that's more of the conversation we have with the funds and the traders who engage in this market. But very much those two sides of things in terms of the cost.
But do you share, like, this makes sense if we're talking about today $1 million worth, or 10 million, or 100 million, or 1,000 worth of it's just so someone can kind of get their mind around, because I'm in a retail world, and I now need to go to, I don't know, Atmosphere, because I decided to visit my in-laws in Mexico, and then I'll find it quite interesting to kind of see how I can pay for good conscience. It seems from €5 to €200, and it seems like the same ton, and I can, there's some form of quality assessment. It's really tough for me, right? I have no idea. But it would just be interesting to to just get a gauge, if you can share, because to me, insurance sums in a total or some form of premium sets allows me to kind of see where these products sit.
Do you mean for you, if you were to buy as a
no, let's say for you. So for example, I let's take the cyber example again, and there was no. I remember I'm working with I think it's in the crypto space, and it says nothing below a premium of $1 million. It's just not. It's not worth it. It's just so this is not, if so that means this needs to be some form of larger entity, an exchange, etc., who is willing to at least pay a premium of $1 million to then forgo a certain loss, because the assessment and the analysis of that thing requires so much upfront in investment on the underwriting. And you would have a similar thing. You can't go to Allianz Global Corporate Speciality, or I think they're now just Allianz Corporate or something. I think they're rebranded. But and you can't buy a policy for 20,000. They don't get to work. For that you need to call your agent in Munich or go through a broker, right? So there's just different layers. For me it would be helpful, but if it's a dumb question, then we can also skip it.
It's not. No, I mean, we do have a bottom level. It's definitely below $1 million. I mean, it depends on the market. So I'd say by the UK, for example, people tend to buy smaller quantities, and we can make efficiencies in terms of how we assess the risk. And so thus we do have a bottom, but it's not
Okay.
gigantic. But likewise, by most of the policies who do come through are in they're larger size investments.
Okay.
Yeah, rather than giving numbers, but yeah, they're decent sized policies.
No, and I also get it, right? If you already started, with, let's say, avoided deforestation project, it's the 12th one might actually lower the hurdle because some of the pre-investments in understanding the audit, etc. So there's
also, to be fair, there's a lot of people buy from the same projects. And there's a lot of projects, but likewise, you can do your assessment on the project, and as such, the second time you see that project, we've already done an assessment on it, and so there's some pre-work we can do in terms of some of the more popular projects out there, in terms of sort of initial assessments. So you can build up efficiencies over time.
How do you go to market? I mean, you're cover holder, so I assume you do go through brokers and sometimes direct. I mean, as cover holders do.
Yeah, exactly. I think we go to market in 3 ways. So one is direct. Obviously, we can't sell directly outside of the UK. The UK is the only market we can sell direct, but we do get a lot of companies who contact us directly, who we then link into brokers as appropriate. And I think that is because right now in the market, there's just not that many companies doing carbon insurance. And so if people Google, they find us, and a lot of people approach us directly. Secondly, we work with carbon brokers. So just like insurance brokers in the carbon markets, you have carbon brokers and carbon marketplaces and carbon exchanges, where people who want to buy carbon and people who want to sell carbon will go to those organizations. And so we work with them as well, because when they're speaking to their buyers and their buyers are highlighting risks, it is useful for them to know the insurance that's available in the market to direct them towards us or to any other insurance company. And then finally, of course, we work with insurance brokers, and that is very much, we've just hired a head of insurance, and his role is to help us build out those relationships. And my guess is that the carbon markets, as carbon plus insurance gets more sophisticated this decade, the market will go more towards insurance brokers, because buyers of carbon will have their own individual risk appetite, and they'll be looking for a tailored portfolio of insurance to meet their needs. And I think that will lend itself to an insurance broker-driven market.
And would you also, because you've mentioned, so when you say direct, this would be I don't know, you go to Shell, maybe not Shell directly, but in principle, you go to big corporates, or as you've mentioned, investors and traders directly and say, listen, this is something that we can help you with. Could you also acquire the projects themselves, as that could help them sell their credits, because it's an insured credit, and if it creates efficiencies around the assessment, now you might get into a conflict of interest around rating agencies, etc., but let's leave that aside, right? Is that also something you've investigated, because that could create efficiency on the assessment side?
Yeah.
As you have more control around it, because you're going one project at a time.
Yeah, definitely. Actually, the projects contact us a lot for that very thing. And so that is another route we would like to develop an insurance product for the project developers as well. We went with the buyers first because they tend to be located in regions that are easier for us to insure. And then also right now we can't insure SMEs, and a lot of the project developers are SMEs or retail businesses that can be quite small.
Because of the cost of underwriting the SMEs and assessment?
It's more just actually as a young insurance company, our capacity providers had a preference that we went with larger corporates for the first buyer, because it tends to, I think, historically working with SMEs or retail customers tends to generate just a lot more complaints. You have a lot more fairness to customers type rules you need to be following. And given it's such a sophisticated product, we saw the potential for maybe needing to have a kind of a much more comprehensive complaints policy. And so we thought it'd be easier to go with corporates for the first year.
Understood. Do you out of interest, do you we've already mentioned one of the substitutes, if you are, is self-insurance, sometimes overly self-insurance, which means you buy 30% more credits and then just playing it safe. Is there big competition already in what you do, either from other cover holders or from let's say the big underwriting teams of large direct carriers, your Alliances, your AXAs, your QBEs, etc., who usually also compete, with the Lloyds market, that kind of area? Do you see a lot of the development competition in that space?
Yeah, I see increasing competition actually. Definitely more and more coming out. I still think though the real challenge right now for anyone is the education of the market. The insurance products right now are patchy. And thus the biggest competition is like you said, the sort of inbuilt insurance mechanisms into the carbon markets that people have been using to buy carbon for the last, however many years. So these are their own buffers, contractual mechanisms they've put into place to manage their own risks. The carbon standards also have buffers where developers, for example, have to put in 20% of their credits, and that provides some protection. So it's all these inbuilt insurance mechanisms and ingrained behaviors that are more of the challenge, I think, right now than competitor insurance products. I think it will actually be very helpful to have more insurance products in the market, because I think this is a market that needs to move to an insured market, but we do need to figure out what is the right level of cover, what is the right price, and that is helped when there are more people out there. The other point I'll make here, which is one of the things I love about insurance actually, because it's such a weird industry in some ways, in that you compete with each other, but you also partner with each other. So both between a company like us and a broker, but also with co-insurance. So some of these deals, like we're a little company, they're too big for us, but we can lead on them. We can use our expertise to price them, but then we need someone to follow us, otherwise we can't do it. And so it's actually very important that there are more insurance companies who come in and want to engage in this market, either developing their own products or being willing to follow others. And I think I do see that more and more. So I see that as a positive thing.
That's a very interesting analogy, because for it's if you're from commercial insurance, it's very common. You organize a co-insurance, someone leads, and it's the usual suspects who go, head to head on all of these businesses. But the beauty of insurance sometimes it does lend itself to collaboration, and therefore you can position your expertise, even though some of your kind of balance sheet commitments might not be as expensive, or you might even want to split them out for your own benefit. Yeah, I see how that makes sense. And in a market that is poised to, what was it, from 2 to 50 billion in the next 10 years, there's usually the tide will lift everyone up who manages to have a boat that swims.
There's no way it's one of those things. I think when you're doing something new, if no one else does it, then you've made a mistake. Right. So
and I remember, so my family background, my dad said that they started classic car insurance in Germany. But between the three of us, I think they stole the idea from the UK and then just brought it to Germany. He was so angry when he tried to pitch it to some insurance companies, or and they just copied it. He was fuming. And in retrospect, they looked back, and the best thing that happened was all of these other companies stealing the idea that they were able to grasp from what you've just told, which is a lot of, it sounds a lot, but it's only the tip of the iceberg, and you'll continuously develop. And if you don't, you'll have that tip of the iceberg, but then they'll educate the market that you can actually buy a different type of insurance, and you just had to be better.
Yeah, exactly. I would like to get to a place where we can all compete on price, on coverage, on customer, sort of in quality of engagement with customers. I think we'll actually do quite well in that market because we are a tech-driven company, and I think we'll have the ability to really analyze the data, pull out the right kind of threads to build the better pricing and the better products. I like the thought of getting to that market. We're just not there today. So, yeah. But that's where I hope we get to.
Three final question. You've just mentioned tech. What type of technology do you use that is helpful for you? Because it's probably different types of technology that we're used to in the retail and SME space, and knowing that some of the, let's say, Excel still seems to be a very widely used technology in commercial insurance and underwriting for obvious reasons, because it has all this great flexibility. But where does technology today play its biggest role in your job of pricing and underwriting these different risks?
So I say at a high level, two categories. So one is our own data ingestion and data modeling, which is where we do not use Excel. My co-founders are tech people. And so I don't really think of us as an insure tech, but we are in terms of how we analyze data. So like any insure tech, we do it as data driven as we can. And the goal is to be able to, from the carbon markets, you have tons of data, to pull that in on a regular basis and then be able to pull out trends, comparisons. And my co-founder, Paul, our chief technology officer, he has experience of building startups that have been able to pull in a lot of data from sort of diverse fields and spot outliers that can start to outliers on the negative and the positive that can start to influence your pricing and your risk assessments. So in terms of our underwriting, very much working towards how can we be as fast and tech driven as we possibly can in this market that is quite complicated. And then in terms of our assessment of the carbon projects is where we, again, both of my co-founders, and particularly our CTO, he's has a PhD in astrophysics and has to transfer that into a very much a strength in terms of using remote monitoring imagery. And so we have that skill set in terms of how we're able to assess the carbon projects at the outset and then also monitor them throughout their life cycle. in a way that doesn't mean that Kita has to have people on the ground all over the world walking around these projects. So I think those two things are real strengths that we bring.
Understood. Conscious of time, is that, Tom, before I take, you've been very patient with me, kind of digging into, we sometimes have these things where it's very insurance specific. He just lets me lead the way because I'm just very interested, because this is gold. But Tom, before I kind of go to the last question, any kind of questions or comments on your end, so people, it's a proof that you know you've had your say.
I'm totally fine, Nick.
Awesome.
No, I mean, what you know is that let's say I'm a little bit also searching in this retail world of let's say this carbon market, but it's a business to business talk you had. So for me, it's no problem to just leave it to you.
Actually, I have one more question. I've just bought the tickets to Mexico. I told my wife, initially I said, let's buy whatever the airline puts on there. Let's buy the most expensive option because that'll trickle, yeah, this is interesting, to the airline heads, and then they'll reinvest more into whatever, making their industry less toxic for everyone else. Then I've had some conflict. I think it was through the Guardian article, or it was some bashing on some really bad stuff that Shell did on misleading, I think, Dutch customers or something. They wasn't a smart move, allegedly. And now I'm back to buying it from someone like Atmosphere, which is like a German one. What would you recommend as a very simple end consumer advice? And let's take an airline, because sometimes for me it will be very hard to take the train to Mexico. It's just tough. Yes. I'll get to Munich, and I'll probably get to London as well. But Hamburg, Mexico City is tough for me. And what would you recommend, knowing what you know? Buy it online, buy it from a trusted project developer, do something else?
Oh, that's a good question. I would say, so at a high level, I think, buying carbon is never a kind of fix all. And so it's always around how can we all, avoid and reduce our own impact. But of course, we all still need to fly sometimes. I do as well. I'm from California. I need to go home. I don't buy from the airlines, just because now we're very specific in how we buy. But if I was a person who was not very well versed in the carbon markets, and you, I guess, have the risk of either making it easy or maybe not doing it at all, I think buying the more expensive option from the airline is probably not a bad shout. Or doing a bit of research and finding one of the trusted kind of retail carbon brokers, maybe a Patch, or who do an assessment of the carbon projects you maybe buy from a sort of regular ongoing. I know there's ways, for example, you can sort of offset your life to some extent, but I do think the number one thing for everyone is trying just to avoid whenever they can, in small ways throughout their own life, rather than anyone. And I say this, I used to be a carbon market skeptic. I do think it's essential to drive financing towards high quality carbon projects that we really need, but avoidance is always the first port of call.
Is there any specific question or topic that is covered too little? Kind of as a last shout out, we don't need to cover it at all and open a whole new chapter. But is there something where you say, guys, you're missing a point here that we haven't covered in this conversation?
The only thing maybe that we haven't covered in this conversation is actually the upside of engaging in carbon insurance for large insurance carriers or reinsurers, because one of the benefits we think we really bring is actually that we directly insure carbon credits. And so when you think about an insurance company who's looking at decarbonizing its operations, and part of that is decarbonizing its underwriting portfolio and its asset management portfolio, actually insuring carbon credits is a completely green risk. It is a pool of literally completely green risk that you are insuring. And as such, it provides a green part of your underwriting portfolio. And then also it has the potential to provide a green part of your asset management portfolio. And so I think it could be a very interesting new market for large insurers and reinsurers, not just on the basis of generating a new income stream, but actually on the basis of achieving their own net zero targets throughout their underwriting and asset management portfolios. And so that's one thing I would encourage people to consider, and maybe very happy, obviously, if anyone's listening and wants to go into more detail on that to speak further.
Awesome. This was very interesting. I was able to take a lot of notes. Natalia, thank you so much for your time. This is good stuff.
Great. Well, thank you very much for inviting me onto the podcast.
Of course, of course. Everyone listening, have a lovely day. And as Natalia said, reach out to her if you want to get on what sounds like a very good impact journey, where you can do good whilst also making sure that the wheels keep turning, and that you get paid for the value that you provide. Awesome.
Great. Thank you very much.
Bye.